My name's Andrew Forrester. I'm co-head of corporate broking at BNP Paribas. I wanted to give you my perspectives on how the investor community has reacted to the COVID crisis, particularly regarding the incredible amount of equity raises that we've seen so far this year to help companies manage the impact of the virus. Every company is different with different needs and requirements, and some sectors have been impacted more than others. But the capital markets have been functioning well, and significant amounts of equity capital have been raised. One very important aspect to this has been the stance taken by the Preemption Group, who early in the process relaxed their rules on non-preemptive capital raises, allowing up to 20% to be raised on a non-preemptive basis. So this is fast to market without the need to prepare a prospectus. So lessons had been learned from the global financial crisis. If you think back to the end of February, we had a toxic combination of events that saw the markets collapse rapidly. The FTSE was down over 30% at one point. And from a personal perspective, speaking to fund managers during this period, it was difficult as many were sitting staring at screens not believing what they were seeing. An initial phase of silence and disbelief as they tried to understand and make sense of what was happening changed to, are you going bust? How much liquidity will you require? And then developed into, how bad is 2020 going to be and when will you get back to 2019 levels of profitability? Finally, a few were talking about how you can take advantage of the situation and emerge stronger. So with that in mind, I wanted to set out 4 distinct phases of the COVID capital raising period. So phase 1 was from mid-March to early May, when we saw the first wave of COVID liquidity raises by those immediately impacted by the virus, or perhaps those who've gone into the crisis with the balance sheet in the wrong place. What was interesting here was that the crisis challenged many traditional perceived wisdoms. Cutting the dividend did not hurt credibility. Share prices often went up when it was cut. Pulling forward guidance didn't create the share price either. It just wasn't credible for management to give forward guidance at this stage. And current trading was terrible. We all knew that, so the market didn't react negatively. Now, if you'd asked your corporate broker 12 months ago if you could raise equity on the back of pulling your guidance, pulling your dividend, and really weak current trading, I think that would have been a very interesting conversation. However, what we did find was that investors were being hugely supportive, constructive, and accommodating. Investors or virtually backing everything that sought to raise capital on scenarios, generally a base case and a downside scenario. They were happy to be wall crossed, and sometimes there would be a cornerstone investor who would want to use the equity raise as an entry point into a company. We saw virtually no rights issues. It was all fast to market, accelerated placings up to 20%. And books were often covered pre-launch, and shares were trading up after the issue as the immediate pressure around liquidity was removed. The markets were working efficiently. Companies were effectively trying to bridge to greater clarity down the line. So phase 1 tended to be liquidity asks and came as part of a package of liquidity measures such as cost and capex cuts, stopping dividends, covenant waivers, new bank facilities, government support and bond issuance. Phase 2 I've called the green shoots of recovery. This was from mid-May to mid-July as we started to look forward to being released from lockdown. Capital raises were now based on better visibility around reopening scenarios for businesses. Companies were either taking proactive steps to increase liquidity or strengthen balance sheets in case of a second wave. Some sectors are more forward-looking than others and opportunistic and wanted fresh capital to deploy to take advantage of market dislocations, such as parts of the real estate sector and the insurance market. There was also growing realization that investors could not and would not support every capital raise. So we did see significant investor fatigue towards the end of the period with weaker aftermarket performance. Some funds were understandably seeing redemptions, and we often saw top shareholders not coming into transactions at all, or at best standing in the corner. So appetite was waning as we limped into the summer break. Phase 3 is where we are today, kind of lower for longer. For many December year-end companies, the H1 reporting season over the summer highlighted an expected weak first half, but also delivered a more cautious outlook for the second half of the year. The outlook and guidance are always closely scrutinised by the market, and there are very few brave words about next year. Most companies remain very cautious with their outlooks, and what has become apparent to many companies is that it's often not a liquidity issue, it's an earning issue that may be trying to solve for, given their covenants and funding structures. Many boards that maybe felt comfortable with liquidity at the onset of COVID crisis did have the opportunity to review the half-1 results, the outlook, the balance sheets, and also revised downside scenarios based on slower and longer recovery periods, particularly with the impact of the second wave, many boards don't feel as comfortable today as they did a few months ago. So we're starting to see what we will believe will be a significant number of larger preemptive issues coming to market with big rights issues. As we said, some sectors have been particularly badly impacted. Some parts of the real estate sector have been hit very hard, particularly retail. You've seen Hammerson and Unibuy coming to market with big rights issues, as have IAG and Rolls-Royce recently. But it's not all defensive. M&A activity is also picking up rapidly, and we've also seen significant support for acquisition finance. Investors will inevitably require to be selective when seeing multiple funding asks, but we expect investors will continue to back management teams they like and will want them to take advantage of situations to deliver longer-term value creation. And then to phase 4. I've called this, can I have some more, sir? Having raised equity earlier this year, and if you see trading deteriorate materially from here, maybe with a second or third wave, to the extent that further equity may be required, will shareholders support a further equity raise? It's not an easy question to answer, as every company is different and every share register has its own characteristics. So I can't give anything more than a broad perspective here. However, if you have to, before you go to shareholders, I think you'd need to demonstrate that all self-help actions have been taken as a precursor to any equity raise, around cost, capex, disposals, covenants, facilities, bond market, alternative sources of funding, including government support. A further equity raise must be seen as a last resort, only being pursued to preserve long-term fundamental value of the company, thereby avoiding actions such as value-destructive disposals of good assets at fair sale prices. In such scenarios, shareholders are not going to like it, but I believe they will be willing to consider helping to support fundamentally sound and well-run businesses which have been impacted by what is an exogenous event. I think management teams will also have to provide clarity around what has changed since the last equity raise, how further capital will enable the business to trade through a slower recovery period, what the revised outlook and capital structure will look like, and also confirm the ongoing strategy in the new normal that we're all facing. So these are my perspectives on how the investor community have reacted to the COVID crisis, and I hope this has been helpful for you.